You open your broker app, you find the stock, you tap buy. It says confirmed, and then nothing. You just assume it worked. You assume the shares are yours. You assume they're safe. But do you actually know what just happened? Because in the 3 seconds between tapping that button and seeing that confirmation, your order passed through multiple companies, a clearinghouse, a central registry, and a settlement system that most investors have never heard of. And here's the part that surprises most people: you don't even legally own those shares yet. The moment you tap buy, your broker receives your order. But your broker doesn't just go out and find someone selling that stock themselves. They're essentially a middleman. They take your instruction and send it somewhere it can actually be executed. That somewhere is usually a stock exchange like the New York Stock Exchange or NASDAQ. Think of the exchange as a giant marketplace where buyers and sellers meet. Your broker submits your order into that marketplace on your behalf. Now here's something most casual investors don't realize. Depending on your broker, your order might not even go to the exchange directly. Some brokers, especially commission-free ones, route your order to what's called a market maker instead. A market maker is a company that's always willing to buy or sell shares at a quoted price. They make money on the tiny difference between the buy price and the sell price, called the spread. This practice is called payment for order flow. It's perfectly legal, but it's worth knowing about. It's one of the ways free brokers make their money. So your order is now out in the market, but it still needs to be matched. Every stock exchange has what's called an order book. It's essentially a live list of everyone who wants to buy a stock and at what price, and everyone who wants to sell and at what price. When you place a market order, meaning you'll take whatever the current price is, the exchange matches you instantly with the best available seller. Someone on the other side of the world, who you'll never know, just sold you their shares. If you placed a limit order, meaning you only want to buy at a specific price or better, your order sits in the book and waits until a seller matches your price. It might happen in a second. It might take hours. It might not happen at all. Either way, the moment your order matches with a seller, the trade is executed. You've agreed to buy. They've agreed to sell. Deal done. But here's where most people assume it's over, and it isn't. The trade is done, but the actual transfer of shares and money hasn't happened yet. That process is called settlement, and it takes time. Most major stock markets now operate on what's called T+1 settlement. T is the day the trade happened. +1 means 1 business day later. So if you buy shares on a Monday, they're officially transferred to you on Tuesday. Until settlement completes, you're in a kind of in-between state. The trade is agreed, but the shares and cash haven't formally changed hands yet. You can see the position in your account, but it's technically not finalized. Why the delay at all? Historically, it used to take 5 days because everything was done on paper. Physical share certificates had to be physically transferred. T+1 is a massive improvement, and the US only moved to it in 2024. Some markets are already pushing towards same-day settlement. So who manages this whole settlement process? That's where one of the most important organizations in finance comes in, one almost nobody outside the industry knows about. Between every buyer and seller sits a clearinghouse. In the US, the main one is called the DTCC, the Depository Trust and Clearing Corporation. It processes trillions of dollars of trades every single day. Here's what it actually does. When your trade is matched, the clearinghouse steps in between you and the seller. It becomes the buyer to every seller and the seller to every buyer. This is called novation. The genius of this is that you never have to worry about whether the person on the other side of your trade is going to follow through. The clearinghouse guarantees it. If the seller suddenly can't deliver the shares, maybe they went bankrupt overnight, the clearinghouse covers it. Your trade still goes through. To protect itself, the clearinghouse collects something called margin from its members, essentially deposits that act as a buffer against defaults. This is the invisible safety net sitting beneath every trade you've ever made. Your trade is now settled. But where exactly do your shares actually live? Here's the part that surprises people most. You don't actually hold your shares directly. Your broker does on your behalf. This is called holding shares in street name. The shares are registered in your broker's name, not yours. Your broker keeps an internal record showing that you own them, but officially, at the central registry level, it's your broker's name on the shares. Above your broker, all shares are ultimately tracked by the DTCC's depository, a central database that records who owns what across the entire market. Physical share certificates barely exist anymore. It's all electronic entries in a massive ledger. This system works seamlessly until you start asking, what if my broker goes bust? This is the question people rarely ask until it's too late. So, let's be direct about it. In most regulated markets, your investments are legally separate from your broker's own money. If your broker goes bust, creditors cannot touch your shares. They belong to you, the broker was just holding them. In theory, you'd get them back. In the US, there's also a backup protection system called SIPC, the Securities Investor Protection Corporation. It covers up to $500,000 worth of securities and cash per account if a broker fails. It's not a government guarantee, but it's a serious layer of protection that has helped investors recover assets from dozens of failed brokers over the years. In the UK, the Financial Services Compensation Scheme covers up to £85,000. Most developed markets have something similar. But, and this is important, these protections have limits. They cover broker failure, not bad investments. If the stock you bought goes to zero, no compensation scheme covers that. And if you're using a margin account where your broker can lend out your shares, your protection gets more complicated. The safest position? Use a regulated broker. Keep your account as a cash account rather than margin, and know what protection scheme covers you in your country. So, is your stock safe? Mostly, yes. But now you know exactly why and exactly where the limits are. So next time you tap buy, you'll know exactly what's happening behind that confirmation screen. Your order goes to an exchange or market maker. It gets matched with a seller. A clearinghouse steps in to guarantee the trade. Settlement happens the next business day, and your shares sit in a central electronic registry held in your broker's name, with legal protections keeping them yours. It's a system that processes trillions of dollars every single day, and it almost always works invisibly and perfectly. Understanding it doesn't just make you a more informed investor, it makes you a more confident one. If you want to follow up on margin accounts, short selling, or what really happened when Robinhood froze GameStop trading in 2021, drop it in the comments. Those stories go deep. Like the video if it helped, subscribe if you're new, and share it with someone who invests but has never thought about any of this. See you in the next one.